Yes, hello guys. So this video is to help you or to show you how to flip a small account to a big account. For example, from like $10 to $1,000 or $500 and so and so. So before you take any trade, you are supposed to identify the bias or the direction of the market of that day. So you must identify the direction of the market. So let me highlight them here. So when flipping a small account, so first you identify the direction of the market. You identify the direction of the market. So you identify the direction of the market, direction or the bias. So remember, I always mention about the daily bias, the direction of the market, and so and so. So the second thing, after identifying the daily bias, so you now start stacking positions or adding more positions as the market go towards your direction. So you are supposed to add your positions using the 5-minute time frame. You add your position using the 5-minute time frame. So 5-minute time frame. So like that. So after identifying the daily bias and you know the direction of the market of that day, and now you want to add more positions, you scale down to the 5-minute time frame. What am I saying? To the 5-minute time frame. So now here is where the journey begins. So under the 5-minute time frame, there are various things you are supposed to notice. And flipping an account is so risky such that you can blow an account using a single candlestick. So under the 5-minute time frame, so under the 5-minute time frame, you are supposed to identify support. You are supposed to identify support. You are supposed to identify resistance. You are supposed to identify the resistance. So after identifying support resistance, you are supposed to identify the breakout. So those are the key factors to consider when flipping a small account. So first, you are supposed to be on the 5-minute time frame. After knowing the direction of the market, you look for support, resistance, and the breakout. So I already know what daily bias is. You always know what is the 5-minute candlestick. That's the time frame. So support, resistance, and breakout. So let's start with support. So support is created when a red candlestick is followed by a green candlestick. A red candlestick followed by a green candlestick, that is a support. Let me show you. So let me show you what I'm saying. So a red candlestick followed by a green candlestick, that is a support. So we have this candlestick like that. So you have this candlestick. This one is a red candlestick. So that is a red candlestick followed by a green candlestick, followed by a green candlestick. So this is how support is created. Support is created when a red candlestick is followed by a green candlestick. So like that one. So support, we use support when the market is on a bearish direction or when the market is selling. So when you identify, so this is a support, this is a support when a red candlestick is followed by a green candlestick, that is a support. So on the 5-minute time frame, when you identify the support and you want to add more positions, so you come and you mark the wick of the longest wick of the candlestick, either being of the red candlestick or the green candlestick. So in this case, you can see we have the current wick is on the red candlestick, so you mark that wick, although I will show you in a using a read example. So that is a support, that is a support, this is a support. So when you want to add more position and the market is on a bearish move, you wait for a candlestick to close below this candlestick, to close below this wick, I mean this wick. So we have another now, a bearish candlestick. So when the market closes this the bearish candlestick closes below this wick, so this is a support, this is a support. When the support is breaking, so the market continues to sell, so you add more positions here. So that is a support, that is a support. So let me just highlight here. So a support. So a support is created when a green candlestick, a red candlestick is followed by a green candlestick. So like that. So support is created when a red candlestick is followed by a green candlestick, like this one. So a red followed by green, that's a support. Red followed by green, support. So let's go to, I think you all have understood what a support is. So let's look at resistance. So resistance. So a resistance is created when a green, it's a vice versa, when a green candlestick is followed by a red candlestick, when a green candlestick is followed by a red candlestick. So we have a green candlestick, you have a green candlestick, have a green candlestick followed by a red candlestick. Followed by a red candlestick. So this is a red candlestick. So that is a resistance. So we use resistance on a bullish move or a bullish direction. So when we are buying, that's when we use resistance. When we are selling, we use support. So this is a support, a resistance, I mean, when a green candlestick is followed by a red candlestick, a green followed by red, green followed by red. So when marking your support, your resistance, we mark the wick, the highest wick. We mark the highest wick. So when you want to add more positions, you mark the wick, the highest wick, and you wait for a bullish candlestick to come and break the support, the resistance, I mean. After the market break the resistance, now you add more positions. So this is a support. A resistance is created when a green candlestick is followed by a red candlestick. So a green followed by red, a green followed by red, that is a resistance. So now you have understood about resistance, support, and I said support is created when a red candlestick is followed by a green candlestick. A red followed by green, that is a support. A resistance, green followed by red candlestick. So when you want to stack more positions now. When you want to stack more positions, you add positions after every 5-minute candlestick. You add positions after every 5 minutes candlestick. So you add positions after every 5-minute candlestick. If the market is going towards your direction, you add positions after every 5 minutes. After every 5-minute candlestick is formed. So after every 5 minutes, you stack more positions. After every 5 minutes, you stack more positions. And now, after you know the direction, the support, resistance, and adding more positions after every 5 minutes, you must consider the market. Let me show you. So you must know when the market is retracing, and this is when we have a change of character or a break of structure. Remember I said a break of structure, it shows that the market is continuing with the direction. So we have a break of structure. Here. Break of structure. Have another break of structure here, and have another break of structure. So when you are stacking more positions, you must know, or we must see if there is a break of structure. You wait for a retest. You wait for the market to either come to an order block or to a fair value gap that is left behind as you can see. So you wait for the market to, if there is one, or if there is one. So kama hakuna, you add more positions, stack more positions. So that's how to identify or to know if the direction of the market is. So let me show you an example. Or before we continue, I've forgotten about something. A breakout. I had highlighted it earlier. A breakout is just a candlestick closing above or below the previous candlestick. So example, so we have this candlestick here. We have this candlestick. Let me zoom for you to see. We have this candlestick, this one. You can see the wick. This is the wick. This is where the market had reached. So the next candlestick closed below it, so that is a breakout. Although that doesn't really matter. So let's have an example about how to add more positions. I don't think if I'll have a better example. Of how to add more positions. Yes, I have an example here. So I've said you add more positions after every 5-minute candlestick. So a minute. I'm looking for a perfect example. Yeah, this one. So this is a better example. So I've said you add more positions after every 5-minute candlestick, after identifying the direction of the market. So because you can't trade blindly. So you can see this is GBP JPY. You can see here the market is on a bullish move. So I've said we add more positions after every 5 minutes. So we have this candlestick. This is where the market reacted from or started going up. So let's assume this was our entry. So that was our entry, and we added positions. We have this long engulfing candlestick, and I've said we have support and resistance in the market as the price continue going. So we add positions after every 5-minute candlestick. So here we can see what was forming. We have a green followed by a red. That is a resistance. So we mark this as our resistance. So this one here, this candlestick, green followed by red. So this is a resistance. So the market formed another resistance. So we ignore the first resistance. We now consider the current resistance. So green followed by red. So we wait for the market to break the resistance. You see this candlestick broke the resistance. So after the market broke the resistance, you can see we had a retest on this candlestick. Now here we add more positions, we add more positions, we add more positions. So we wait for the next 5-minute candlestick. So you can see this candlestick closed above the previous 5-minute candlestick. This candlestick closed above the previous 5-minute candlestick. So that is a breakout. That is a breakout. So you add more positions, you add more positions, you stack more buys, you stack more buys. So let me repeat again. So this was your entry. You added more position, you added positions here. What am I saying? You added positions. So you wait for that candlestick to close. Remember, we are using the 5-minute time frame. We are using the 5-minute time frame. So after this candlestick closed, we had a resistance. So this is a resistance, a green followed by red, green followed by red. So we had a resistance. So we mark the highest wick of the candlestick, either on the green or red, whichever candlestick has the longest wick. So you mark it. So this was our resistance, and then the market formed another resistance, green followed by red. So we mark the highest wick, the green one, on the green candlestick. So you wait for the market to break that resistance. You can see this candlestick broke the resistance and closed above it. So you add more positions, although we have a retest. So you wait for a retest on for the next candlestick. You add more positions. You wait for that candlestick to close. So you see this candlestick closed above the resistance. We added position using this candlestick. It closed above the previous 5-minute candlestick. We add more positions. We add more positions as the market goes, and the market moves, as the market moves. So let's use another example here. Let me look for another example. Yes, we have this example here. Still on GBP/JPY, the trend is bearish. The trend is bearish. The trend is bearish. So let's say this was your entry. This was your entry. Of course, the entry is on the higher time frame. Let's say the market, the entry was on the higher time frame, maybe the 1 hour or 4 hours. So let's assume this was your entry. This was our entry. So this was our entry. You added positions. And the market, the 5-minute candlestick closed this one. The next candlestick formed a green candlestick. Notice, a green candlestick. Now, because we are on a downtrend, so this is a support. Remember, I said the support is created when a red candlestick is followed by a green candlestick. So this is a support, this one. So we mark the wick of the highest wick of that candlestick. So you can see the green, red, green. So the green has the highest wick. So we mark its wick. We mark its wick like that one. So we mark the wick of the green candlestick. So this is a support. So you wait for the market to break the support with a bearish candlestick, because we are on a downtrend. We are selling. So the market broke the support. After the market broke the support, what do? You go in full margin. You stack more positions, add more positions, stack more positions. So you wait for the next 5-minute candlestick. So the next 5-minute candlestick, this one, So the next 5-minute candlestick, this one closed above or below the support, so you add more positions. So this candlestick, this one closed below the previous 5-minute candlestick, you add more positions. You wait for the next candlestick, you add more positions, add more position. This candlestick closed below the previous 5-minute candlestick, add more positions, add more positions. So imagine from this point, from this our entry to this where the market reached before it started consolidating, because you can see the market started consolidating before it goes bullish. Imagine stacking more positions. So we have 1 2 3 1 2 3 4 5 6 7 8 9. We have 9 candlesticks. Imagine adding more positions on 9 candlesticks. So that's a clear that's a clear full margin. So let's look for another example on Euro USD. So this is the current trade that we took, although I got stopped out and my account was gone. So let's use another example. How to add more positions using the 5-minute time frame. When identifying support, resistance, breakout. This one doesn't have a clear. Oh yeah, we have this example here on GBP USD. So as you can see here, the market swept the liquidity. A clear confirmation that the market is bearish. So the market swept the liquidity, so you add more positions. From this point. So after adding more positions, although the higher time frame bias is still bearish, so this is just a confirmation on the lower time frame that the market is going the same as the higher time frame direction. So you have this candlestick, you add more positions, you wait for the next 5-minute candlestick. So you can see this candlestick, this candlestick, you mark its low like that one. Just zoom. So you mark the low of this candlestick, so and you can see the market consolidated now on a lower time frame, either the 3-minute time frame or the 1-minute time frame. The market consolidated and we had a green followed by red, green followed by red, green followed by red. That is a support. So you can see the market failed to break our support, our resistance. So this is a resistance, green followed by red, a resistance. So you can see the market failed to cross above the resistance. Failed to cross above the resistance, and it took out the liquidity of the previous candlestick. So even though that is not important, so after the market failed to break the resistance, you add more positions. So you wait for the next candlestick. So this candlestick, you wait for it to close. So you must wait for the market to close. I mean the candlestick to close. So we have this candlestick. this one. So you can see this candlestick closed below the previous candlestick, so you add more positions here, you add more positions. So you see so this candlestick closed below this, you add more, as in you add more positions after every 5 minutes. So you add more positions, add more position, add more positions. So you can see the market had a retest on this 5-minute time frame fair value gap. So you add more positions, after on the fair value gap, add more positions, add more positions, add more positions. Now here the market was consolidating. As the market was consolidating, what did it form? A support, a red followed by green, a red followed by green, red, green. So you mark the week of the longest week of either this red candlestick or the green candlestick. So you can see the red candlestick has the longest week, so you mark the week, so that becomes our support. So you wait for the market to break the support. So you can see the next candlestick, this one now, broke the support. After the market broke the support, you add more positions. After every 5 minutes, add more positions. So you can see here we had another support. Red followed by green. So green has the longest week. You mark it as our support. You see the next candlestick didn't break or close below the week. It didn't broke the support. So you don't add more position yet. You wait for a clear confirmation, and the confirmation is the candlestick that will broke the resistance and close below the support. So we have this candlestick broke the support, and broke the support. So you add more positions. After every 5 minutes, add more position. After every 5 minutes, stack more positions until you reach your take profit. So now this is another example now on a bullish move. So let's say we had our entry. So this was our entry. Of course, you must know where to enter, either on the higher time frame. So this was our entry. So you added more position. You added positions here because that was the original entry. So you added positions there. So you can see you had a red followed by green. So you add more positions, add more positions. After every 5 minute candlestick, you add more positions. So that this was our first entry, second entry, third entry. So on that entry, we had a support here. So this is a major support. Remember the support of, so we are using the support that is formed by two candlesticks. So we have this resistance here. So this is a major resistance. So on a major resistance, we still have a minor resistance, a green followed by red. So let's ignore this. So a green candlestick followed by a red candlestick. So you see the green candlestick has the highest wick, the longest wick. So you mark the wick. You wait for the market to break the support, the resistance, So this candlestick broke the resistance, add more position until you reach your TP. Add more position. So I think that is the strategy behind flipping a small account. Strategy of flipping a small account. So let me highlight to them again here. A summary. So I've said you must consider the bias or the direction. So you consider support. You must wait for support to be broken. Support, resistance, breakout, so support, breakout, and you are supposed to be on the 5-minute time frame. 5-minute time frame, not 4. It's 5-minute time frame. That was bias in the 5-minute time frame. So bias or direction, support, and a support is created when a red candlestick is followed by a green, red followed by green support. Resistance, green followed by red, green followed by red. So you must supposed to be on the 5-minute time frame. Wait for breakout. I've said a breakout is when you have a candlestick. So this is the week of the candlestick. So we have the next 5-minute candlestick. So like that. So we have this candlestick and we have its wick. So we have its wick like that one. So the next candlestick closed above the previous candlestick's wick. So you can see this candlestick closed above this candlestick's wick. So that is a breakout. The wick the candlestick closing above or below the previous candlestick's wicks. That is a breakout. This one, that is a breakout on the bullish direction. On the bearish direction, what am I saying? So on the bearish direction, so we have this candlestick, we have its wick. You can see the market and the next candlestick closed below it. So now this is on a downtrend. So that is a breakout. A breakout when the candlestick closes above or below the previous candlestick's wick. So now this on the lower time frame, on a higher time frame, on the daily time frame, that is a bias. That is the bias. So let me show you what I'm saying is if the candlestick, so we have this candlestick, we have this wick. You can see this candlestick closed below this wick. It crosses below this week, so that is a breakout. Now we have this one, crossed above, crossed below the previous candlestick, that is a breakout. So we have this candlestick, you wait for it to be broken, so that is a support. So this is a support, that is a support. Now you mark this support. So now this is not a breakout, this is not a breakout, it is a support. So you wait for the market to break the support, you enter sales, you add more positions, after every 5-minute candlestick, So if you have a question, just feel free to ask. So this is example of the market that I was trying to flip an account of $10 with, but I ended up being stopped out. Let me show you. So we had the daily time frame bias was bearish, so we had a 4 hours fair value gap. So we had this liquidity sweep. We had this liquidity sweep on the 5-minute time frame and a fair value gap. What am I saying? For the 5-minute time frame. So yeah, had this liquidity sweep. We had this fair value gap, so entry, and a change of character. So this is a change of character. So this was our entry. So I added how many positions? So these 1, 2, 3. So we had this 1, 2, 3, 4, 5, 6, 7. But that's not important for now. If you have any question, feel free to ask. So that's how to flip a small account using support, resistance, breakout, and whatever. So see you next time.